On Monday, October 19th, 1987, the Dow Jones fell 22.6% in a single trading day, the largest one-day plunge in modern market history. Traders on the floor watched prices vanish, phones go dead, and computer models spin into the red. Commentators called it panic, but panic wasn't the cause. Panic was the smoke. The fire had already started. The real trigger was something new, something built to make markets safer. Program trading. Algorithms designed to protect portfolios collided with human market making and turned a sell-off into an avalanche. If everyone was hedged, why did everyone get hurt? This is where money, power, and history collide, because nothing on Wall Street is ever as simple as it looks. Black Monday didn't arrive from a clear sky. It was engineered piece by innovations that promised stability, liquidity, and discipline until all three disappeared at once. What broke wasn't the market. What broke was the floor, the human buffer between orders and oblivion. It broke because machines move faster than humans could quote, and faster than the rules could adapt. To understand how a strategy called portfolio insurance and a practice called index arbitrage detonated together, we have to go back to the moment when markets still relied on chalkboards, hand signals, and a myth that the floor could absorb anything. The place to start is the early 1980s, when the future of markets quietly moved off the floor and into the mainframe. Exchanges had always been human. Specialists and market makers posted two-sided quotes, kept an orderly book, and took the other side when imbalances appeared. It wasn't charity, it was inventory. Liquidity was a business, and the floor was a shock absorber. Then a new architecture arrived. Index futures launched on the S&P 500 in 1982. Options on indices and single stocks exploded in popularity. Personal computers crept into trading rooms, and quantification became a creed. If you could measure risk, you could mechanize it. If you could mechanize it, you could scale it. And if you could scale it, you could make volatility predictable, on paper. Program trading took shape inside that optimism. It bundled orders across dozens or hundreds of stocks and linked the futures pits to the cash market. The basic arbitrage was elegant. If S&P futures got too cheap relative to the cash index, you bought futures and sold a matching basket of stocks. If futures got too expensive, you reversed it. A few keystrokes replaced a dozen runners in a forest of hand signals. The human floor was about to meet its mechanical ceiling. The promise was seamless risk transfer between venues. Under stress, the innovation fulfilled its promise with brutal honesty. It transferred stress just as seamlessly. Then came the fuse, portfolio insurance. The pitch was simple and irresistible. If the market fell, you sold futures short against your portfolio of stocks. The lower it went, the more you sold. You mimicked the payoff of a protective put option without paying the upfront premium. It was math as comfort, a glide path that promised you could control your downside, like an autopilot that would gently descend you through turbulence. But the autopilot had a flaw. Portfolio insurance is pro-cyclical by design. Falling prices trigger selling. More falling triggers, more selling. It's like promising to sell a little gasoline each time you see a fire, until you have poured out the entire can and the fire is larger than the house. There was a second flaw buried inside the model. A quiet, almost invisible assumption about liquidity. The equations expected a counterparty at each step. Someone would take the other side at each incremental sale. Who would that be? In theory, index arbitrageurs would buy stocks against the short futures that the insurers were selling. In practice, that meant pushing bigger and bigger baskets back to the floor, where humans had to process them and where capital was finite. The system's safety valve and its stress test were the same instrument. By late summer of 1987, the backdrop was already souring. Interest rates were rising. The dollar was wobbling. After a multi-year bull run, valuations were stretched and nerves were thin. The market was searching for an excuse to exhale and found several. Trade tensions, fiscal uncertainty, and a sharp sell-off on Friday, October 16th, that ended on a weak close with liquidity already thin. Over the weekend, the headlines got worse and the models kept humming. Monday's opening bell did not ring in a new day. It released a wall of water. As the bell rang, sellers hit bids across the board. The futures markets lurched lower. Portfolio insurance said, sell more futures. Index arbitrage said, sell the equivalent basket of stocks to keep cash and futures aligned. Specialists said, we'll try. Phones jammed. Clerks couldn't confirm fills. Some stocks went fast market, code for quotes you couldn't rely on. The futures markets were discovering a new price while the stock market was still choking on the old one. Every second of lag was a profit opportunity for programs and a risk explosion for humans. The system became a feedback loop. Futures push stocks, stocks confirm futures, hedges sell into the hole, liquidity evaporates. The floor was no longer a marketplace. It was a spillway. To understand where the floor cracked, zoom into the microstructure. Specialists had three jobs: post quotes, maintain order, and manage their own risk. They were the last buyers when buyers vanished. But on this day, the book turned into a black hole. Order flow was one directional. Sell baskets, over and over. When the tape prints sell thousands of times in a row, a book that looks deep on paper empties in seconds. Humans update quotes in seconds. Programs generate new selling pressure in microseconds relative to human response. Quotes that were fair on entry were stale on arrival. Specialists widened spreads, then stepped back. Inventory, a lifeline in calm waters, became an anchor in a rip current. Price discovery split in two. The true price was being discovered in the futures pit, not at the post. The floor was downstream, paddling against a current set by machines across the river. And then there was capital. Specialists are not shock absorbers without limit. Their balance sheets are finite. When the inventory bucket fills, bids vanish. The promise of continuous liquidity depends on discontinuous human balance sheets. Program trading discovered the edge of those balance sheets instantly. Index arbitrage, meanwhile, was doing exactly what it was built to do: close the gap between futures and cash. In normal times, that gap is narrow and the arbitrage is smooth. But when the cash leg is 500 stocks and half of them are untradeable at posted quotes, the arbitrage leg becomes a wrecking ball. Traders sell whatever is liquid to approximate the basket. The most liquid names become the exit door for the entire building. They get crushed first, deepest, fastest. The illusion of equal liquidity across a basket breaks into shards, and the shards cut in predictable places. Portfolio insurance turned mechanical hedges into a stampede. It forced sell-low behavior. Lower prices increase the short futures position. The model sells more. That is the opposite of value investing. It is momentum hedging. Under normal conditions, the market gives you a staircase. On Black Monday, the staircase vanished. Each step dissolved before the trade could print. Hedges became chases. Arbitrage amplified the chase. When futures fell faster than cash, arbitrageurs sold stock to close the gap. That selling pushed cash lower, which dragged futures lower as insurers sold even more. A mirror answered a mirror, and the reflection became a tunnel. Then the bid disappeared. In quiet markets, it looks like there is always a bid. In panic, bids are ghosts. Spreads widen, then collapse outright. That is when program logic meets human survival. Traders pull, cancel, and wait. The model still says, sell more. The market asks a question the model cannot answer. To whom? It wasn't panic, it was plumbing. Not fear, but feedback. Not psychology, but microstructure. By the close, the damage was historic. The postmortem did not conclude, ban the computers. The conclusion was sharper, rewrite the rules. How do you slow a feedback loop? How do you stop a runaway futures market from dragging the cash market into the void? How do you force time back into a system that just erased it? The answers became the architecture of modern trading. Market-wide circuit breakers, which halt trading after preset percentage declines, inject minutes into a machine that devours seconds. Single stock collars and limit up limit down mechanisms, which pause individual names that gap beyond a band, act as local fuses to complement the main breaker. Coordination across venues, so that futures and cash playbooks acknowledge each other under stress, keeps one market from pretending it is slow while the other screams. Transparency and audit trails, which map who sold what when, teach regulators and exchanges where the next loop might form. None of these changes eliminated risk. They redistributed it in time. Instead of one catastrophic day, we get a series of controlled burns. There is a temptation to rewrite the story as a morality play, but the myths obscure the mechanics. The first myth says Black Monday was pure emotion. Emotion amplified the move, but deterministic strategies set it in motion. Portfolio insurance and index arbitrage responded to prices, not feelings. The feeling came after. The second myth says arbitrageurs caused the crash. Arbitrage transmits price between markets. If the messenger arrives with a wrecking ball, it's because one market discovered a price the other refused to print. In 1987, futures discovered the price. Cash resisted. Arbitrage enforced the verdict violently. The third myth says the floor failed. The floor performed under rules designed for human tempo. It failed as a design, not as a group of people. You can't ask a fire hose to behave like a garden sprinkler. The system put a fire hose through a handheld nozzle and hoped for the best. The fourth myth says portfolio insurance was insurance. Insurance pays you when disaster strikes. Portfolio insurance created the payout by selling into disaster. It assumed the exit door was always open and always the same size. In a crowded theater, it made the door smaller and the crowd larger. The core mechanic is simpler and colder than the myths. Pro-cyclical strategies crowded into the same path will turn a sell-off into a stampede. The more identical the model, the less resilient the market. Diversity of behavior is not a luxury, it's a public good. When models internalize the same rule, sell when it falls, buy when it rises, markets internalize fragility. That was true when portfolio insurance was the fashion. It remains true as fashions change. The echoes are loud. We don't use the same code, but we use the same logic. Volatility targeting funds that cut exposure when realized volatility rises, leveraged ETFs that rebalance into weakness, option dealers who hedge deltas and gammas in ways that can accelerate intraday swings, ultra-fast market makers who are deep until they are not. The names and faces changed. The dependency on continuous liquidity did not. Circuit breakers buy time, but not courage. Price bands stop prints, not pressure. Fragmented markets still answer to the fastest venue. In 1987, price discovery sprinted ahead in the S&P futures pit, while the cash market lagged, coughing. Today, during stress, price can form first in options volatility, in dark pools, or across a patchwork of order books. The rest of the system chases. The deepest echo is the oldest, the safety device that becomes an accelerant. Portfolio insurance was invented to limit losses. Under stress, it forced sales, which created more losses. Modern hedges have the same double edge. A strategy designed to offload risk does not make risk vanish. It moves it. In 1987, risk migrated from price to liquidity and detonated there. In other episodes, it migrates to funding, collateral, or counterparty chains. The lesson is not that hedging is futile. The lesson is that maps of risk need to include the bridge everyone is crossing at the same time. Picture one large pension fund on Black Monday. Its model says, at 5% down, sell a block of futures. At 10, sell another. At 15, sell again. It executes the first tranche. Futures, gap lower. The model sells more. Arbitrageurs see the spread open and sell stocks to keep cash aligned. Specialists step back. Quotes widen. Some stocks go no bid at posted prices. The fund's next tranche hits a market that no longer exists at the last price. The insurance sells into air. Multiply that by dozens of funds calibrated with similar deltas, all trading the same futures, all relying on the same arbitrage to transmit their hedge. You don't get a sell-off. You get a loop. The more you hedge, the more you must hedge. Protection burns itself as fuel. So what do we keep from the wreckage? 3 words: time, diversity, friction. When time collapses, markets do too. Halts, collars, and auction reopenings are not anti-market. They are anti-cascade. They force time back into decisions that algorithms compress to nothing. Diversity is more than a portfolio slogan. If everyone hedges the same way, the hedge becomes the hazard. Strategies that respond differently to the same shock, some value-seeking, some liquidity-providing, some patient capital, make the system breathable. Friction is not always a tax. Zero friction is not zero cost. It is infinite speed. A little friction at the right place prevents infinite loops. Auctions to reset price, disclosure to calm uncertainty, coordination to keep fast markets from pretending the slow ones can keep up. There's a quieter lesson too, one the tape still tries to whisper on hard days. Liquidity is not water in a tank. It is a behavior performed by people and machines with capital at risk. It exists until the moment it is needed most. Then it asks to be paid. In 1987, payment came due all at once. The bill was 22.6%. The stock exchange floor was never just a room. It was a promise that human balance sheets and judgment could absorb shocks. In 1987, that promise met a new reality. Code moving faster than capital, rules assuming the opposite. The floor broke because it was built for traffic that no longer existed, while the superhighway roared past it and looped back over the same bridge. Today's floor is mostly digital. The promise is the same. We will keep discovering where it cracks, and we will keep patching it. That is the modern market. Invent, stress, break, reform, repeat. Survival doesn't come from perfection. It comes from patching the right seams before the next storm arrives. If you strip away the headlines and the finger pointing, the mechanism left behind is stark. Program trading didn't cause fear. It synchronized behavior, compressed time, and transformed a downturn into a self-fulfilling hedge spiral. The floor didn't stop because floors are built from balance sheets, and balance sheets are finite. And yet the response proved that markets can learn. We didn't ban engineering. We built speed limits for it. We didn't swear off hedging. We forced time into it. We didn't fire the messenger. We taught the venues to talk to each other when the message turns violent. The chart still carries the scar. A void under the date, a cliff where candles fall like stones. That scar is a warning and a map. It says that identical rules running at identical speeds will always amplify their own rhythms. It says that liquidity is a fair weather friend unless you force it to stick around in the storm. It says that a human floor can be overwhelmed, and a digital one can too, unless you build places where price can pause, breathe, and reset. Black Monday is not a mystery to be solved. It is a mechanism to be remembered because it keeps returning in new clothes, asking the same question. When everyone tries to leave through the same door, who stands in the doorway? History answers with the same cold clarity. If time vanishes, restore it. If behavior synchronizes, break it with pauses and auctions. If one venue runs ahead, teach the others to catch up before they fall. If risk migrates, follow it across bridges and tighten the bolts before the crowd arrives. The lessons are not romantic, but they work. and they were purchased dearly. That is why the day still matters. The tools change, the tempo quickens, the stories update with new acronyms and new heroes. But the structure is familiar. Markets are great at distributing information and terrible at distributing urgency. Urgency concentrates. It becomes one price, one venue, one path, one exit, and then it becomes a stampede. The cure is not to outlaw urgency. The cure is to make space around it, to stretch seconds into minutes, to stretch identical incentives into a spectrum, to stretch thin bridges into wider ones. In 1987, the market forgot how to stretch. It snapped. The fix was to stretch back into the design. So remember the room that broke. Remember the models that agreed too much. Remember the bids that turned into ghosts. And remember the rule that outlives every strategy. In engineered markets, risk never disappears. It moves into the assumptions you forgot to stress, the venue you forgot to watch, the bridge you forgot to widen. The trading day ended, the bell rang, and a half century of confidence went home sick. But the system came back with new scars and better seams, and that is how markets learn. Badly, expensively, and permanently. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.